On to your markets news now. Asian markets appeared mixed. Poorer than expected US data rattled sentiment a little, but in instances of weaknesses, this was tempered to a degree by news that US-China trade talks were progressing well. In Japan, after 4 straight days of gains, the main market slid today. The Nikkei share average index ended the day down 0.2%. Mainland China and Hong Kong markets closed in positive territory. The Hang Seng index ticked up 0.65%, while the Shanghai Composite Index rose by 1.9%. Over in the United States, US stocks were pressured on Thursday on the back of weak economic reports. This comes after the market's recent run of gains and a drop in healthcare shares added to the bearish momentum. The Dow Jones Industrial fell by 0.4%, the S&P 500 lost 0.35%, and the Nasdaq Composite dropped by 0.39%. Global markets are trading generally in positive territory today, although Japan's Nikkei share average declined slightly. The local all-share index has traded as high as 0.7% this session. Meanwhile, the local currency appeared to make slight gains earlier, but is trading more or less around its New York close levels. The commodity prices we tend to track are generally up, with Brent crude oil hovering around $67 a barrel. Broadly speaking, sentiment about the progression of US-China trade talks seem to be positive. Let's take a look at the indicators. Well, to take us through the markets, I'm joined in studio by Warwick Lukas. He's Chief Investment Officer at Galileo Capital. Always a pleasure.
My pleasure.
Good stuff. So global markets generally seem to be quite positive. Any catalysts for this happening?
Well, curiously enough, markets have been fairly positive in the face of weak economic data, and the reason that happens sometimes is that when there's a concern, as we had recently with the Fed suddenly stopping from potentially over tightening, and then you get weak economic data that follows, it goes to show that actually was the right call, and that it actually keeps the Fed off an aggressive footing, which in turn is actually positive for markets because it shows that the right direction's been followed.
And then on top of that, sentiment seems to be a bit better because we're getting word out of those US-China trade talks that there seems to be some progression. There are apparently some 6 memorandum of understanding, which is very specific detail about basically they're fine-tuning the language, and it's all about China basically reforming. It doesn't really speak to what the US has to do, but that's positive, right?
Well, what's been notable about the whole trade talks process is we've had a week-by-week percolation, and it's just steadily come through, and it's a positive drip. Now, we know that frankly the March deadline is going to scream by and get missed, but quite clearly the discussions are constructive, they're headed the right way, and they're very, very important discussions to get right. So I think it's quite cheering to participants.
So we've been getting lots of headline news about a number of companies leaving the UK as a result of the Brexit uncertainty. Theresa May, bless her socks, is trying her best to try and get a deal. Do you expect that she's going to ask for an extension? And if she does get a 3-month extension to try and get a better deal, is she likely to get one, given that she struggled for the past 2.5 years?
Okay, so I think what's going to happen is this really is going to get taken right to the end, and part of it is going to involve ideology and practicalities running smack face into each other. I think as we saw, first of all, her original deal got voted down massively, and then was followed up by Parliament passing a motion that UK would not leave without some kind of a deal. So I mean, obviously those are two actually countering points. I mean, they say one thing and then they say we'll do another. So frankly, something is going to have to get pushed hard and crack. Whether that's an extension of the deal, whether it's a new referendum entirely, whatever, there's got to be some hard key point that gets pushed and gives. So I'm afraid Brexit is going to be a very squeaky wheel right up until the 30th of March.
And then, of course, here at home in South Africa, we got that budget speech that was eagerly anticipated. And one of the main concerns, obviously, is our debt trajectory. The National Treasury telling us that by the year 2023, 2024, we're going to have debt levels of about 60.2% of GDP. Do you think we've averted all the noises around that number? We've averted a downgrade from the likes of Moody's, who's actually the most important?
Well, I mean, we can't rely on the goodwill of Moody's forever. And I think that the kind of discussions that the Treasury will be having with Moody basically will lay out the terms of last chance saloon, because quite frankly, that's where it's at. Not only has the wheel squeaked, it got rusted up, seized and crashed the whole car into the ditch just about. Eskom needs a massive restructure, and I think we really need a revolutionary new way of looking at things, and I mean that in a logical, globalized sense, in that it gets run as electricity companies should be around the world and hasn't been in the last 30 years.
Well, that's a conversation for another day. Thanks as always, Warwick, for your time. That was Warwick Lukas. He's the Chief Investment Officer at Galileo Capital.